Good morning. How oil prices shape Houston's CRE market and what investors should expect in 2026. So, Houston's commercial real estate market has always been tied directly as well as indirectly to the global energy economy. And even with ongoing diversification into healthcare, tech, manufacturing, and logistics, oil price volatility still influences CRE demand, absorption, development trends, capital flows, and investor sentiment. And for developers, investors, and business owners operating in the Houston metropolitan area, understanding the energy cycle isn't optional, it's strategic. So, why oil prices still matter in Houston? Well, oil remains one of Houston's most fundamental economic engines. When oil trades above long term averages, typically $70 to $80 per barrel, energy companies expand capital budgets, hire aggressively, and lease more space. Conversely, when prices fall back, companies cut back spending, pause expansions, and consolidate office footprints. So here are some key CRE impacts. So office demand in West Houston and the energy corridor, as well as in Uptown, rises when drilling activity and exploration budgets increase. Industrial demand strengthens as midstream and downstream operators expand their warehousing, logistics, and fabrication spaces. And retail and multifamily performance improves with job growth and higher household incomes tied to the energy sector. Number two, high oil prices equals increased commercial real estate activity. So when prices sustain above $80 per barrel, office absorption improves, especially Class A towers near energy hubs. Industrial leasing accelerates, driven by equipment storage, manufacturing, and service companies. But also medical and retail expansions gain momentum as consumer spending rises. Land prices increase, particularly around Katy, Fulshear, Brookshire, and West Houston, as developers prepare for the next cycle. And Houston's most energy centric submarkets are the Energy Corridor, West Chase, the Galleria, as well as North Houston Industrial, and those typically lead the recovery. Three, low oil prices equals slower CRE growth. So when oil dips below $60 for extended periods, office vacancy rises, particularly in older Class B and C buildings. Industrial tenants reduce their footprints or delay expansion timelines. And retail spending slows, affecting suburban shopping centers. As well as investment sales volume falls as buyers anticipate lower net operating income growth. However, low oil prices do not impact Houston as severely as in the past decades due to the rise of medical, logistics, tech, and manufacturing employment. The city is really more diversified than it ever has been. Number four, why industrial remains the most stable sector. Even when oil declines, industrial holds up better than other sectors do. I think that's largely due to the Houston's position as global petrochemical hub because of the Port of Houston's demand, as well as manufacturing and logistics growth and corporate reshoring and supply chain diversification. This makes industrial and flex properties ideal hedges during oil downturns. Number five, how CRE investors should adjust to oil cycles. Smart investors monitor Brent and WTI price trends to position capital strategically. And when prices rise, it could be a time to acquire value add office or an industrial in the energy corridor. Or you can consider land near I 10, FM 1463, and Grand Parkway, and expect higher rent growth and lower concessions. But when prices fall, you can look for discounted office assets and buy industrial properties with long term credit tenants. You can focus on medical office and retail in high income suburbs like Katy and Fulshear. Number six is outlook for 2026. So most analysts project oil prices to remain inside a stable band in 2026, supported by global supply constraints, as well as strong demand from Asia and continued U.S. export growth, and also because of OPEC and their production strategy. Now, this positions Houston for steady CRE performance with industrial, medical, and mixed use leading the way, and office recovery continuing in energy oriented submarkets. That, my friends, is it for the day. Please visit my website, Houston Real Estate Brokerage, for resources and to schedule a consultation. Thanks for your time.